Welcome back to the Daily Crypto Roundup. Before we get into today's markets, a quick personal note. As we mentioned on Friday, there was a chance we might see a short pause because Glenn's baby was due. We're very pleased to say she's here, safe and sound, and doing brilliantly. Now let's get into what has been one of the most geopolitically charged 72-hour periods crypto has seen in a long time. Over the weekend, markets had to digest direct U.S.-Israel airstrikes on Iranian targets. Traditional equities were closed, bond desks were closed, but crypto wasn't. That meant Bitcoin, Ethereum, XRP, Solana. They became the live global risk dashboard while everything else was paused. And the first major headline to hit was this: Bitcoin surged above $68,000. According to reporting from CoinDesk, Bitcoin briefly pushed through the $68,000 level amid what they described as a relatively muted reaction in stock futures. Oil spiked. Gold moved higher. Treasury yields adjusted. But equities didn't collapse in the dramatic fashion some expected. Bitcoin's move was sharp and volatile, but not disorderly. It looked less like panic buying and more like thin weekend liquidity amplifying positioning flows. Julio Moreno, head of research at CryptoQuant, noted over the weekend that Bitcoin's open interest had not expanded aggressively into the move, suggesting this wasn't a heavily leveraged breakout, but rather a repricing event within existing positioning. Meanwhile, Andre Dragosh from Bitwise pointed out that Bitcoin continues to behave like a high-beta macro asset in moments of geopolitical shock, tracking liquidity expectations more than traditional safe haven demand. In other words, this wasn't digital gold suddenly replacing bullion. It was a 24/7 risk instrument reacting faster than every other market. That distinction matters. When geopolitical shocks hit during normal trading hours, flows rotate in structured ways. Equity funds de-risk gradually. Volatility desks reprice options. Bond markets absorb defensive flows. But when shocks hit over a weekend, crypto becomes the pressure valve because it's the only venue open with sufficient depth to handle billions in real-time adjustment. That's exactly what we saw. Bitcoin ripped higher, tested liquidity above $68,000, and then retraced once futures markets began to stabilize. It tells you this was repositioning, not sustained capital flight into Bitcoin as protection. At the same time, another major data point emerged. Blockchain analytics firm Elliptic reported that crypto outflows from Iran's largest exchange, NoBytex, surged 700% within minutes of the airstrikes. 700%. That is not background noise. That is immediate reaction to geopolitical stress. Tom Robinson, co-founder of Elliptic, commented that while spikes like this do not automatically imply sanctions evasion or coordinated state activity, they do demonstrate how quickly individuals move capital when uncertainty rises. Crypto is frictionless, borderless, instant. If you're in a jurisdiction facing potential financial restrictions, currency instability, or capital controls, digital assets become an obvious liquidity bridge. And that is precisely why stablecoins and Bitcoin increasingly sit at the intersection of geopolitics and finance. Which brings us to Europe's next move. A number of European banks operating under the name Kivalis is developing a MiCA-compliant euro-pegged stablecoin targeted for launch in the second half of 2026. Under the European Union's markets and crypto assets regulation, banks now have a clear framework to issue regulated deposit-backed digital tokens. According to reporting, Kivalis is already in discussions with exchanges to ensure liquidity depth at launch. Patrick Hansen, Director of EU Strategy at Circle, has repeatedly argued that MiCA gives Europe a structural advantage by providing legal certainty, while the US regulatory landscape remains fragmented. His view, and it's increasingly echoed across the sector, is that regulatory clarity accelerates institutional participation rather than suppressing it. Europe does not want to remain structurally dependent on dollar-denominated stablecoins for digital liquidity. USDT and USDC dominate global order books today. A euro-native alternative changes that balance over time. And while Europe builds compliant stablecoin rails, institutions in the United States are quietly accumulating Ethereum. Bitmine Immersion Technologies has boosted its Ethereum holdings to 4.47 million tokens following a $98 million purchase. That makes it one of the largest institutional Ethereum holders globally. More importantly, the company is staking those holdings. This is not passive treasury exposure. It is active yield generation within Ethereum's proof-of-stake system. Qi Youngju, CEO of CryptoQuant, recently highlighted that long-term Ethereum staking participation continues to tighten liquid supply, reducing the float available on exchanges. When large entities accumulate and stake millions of tokens, they are effectively removing liquidity from the open market for extended periods. That doesn't create instant price spikes, but it alters multi-quarter supply dynamics. It builds structural scarcity beneath surface volatility. Now connect the dots. Geopolitical escalation. Iranian exchange outflows surging 700%. Bitcoin reacting in real time above $68,000. European banks preparing regulated euro stablecoins. Public companies accumulating and staking millions of Ethereum. This isn't random chaos. It's a financial system gradually reorganizing itself around digital rails. When bombs fall, crypto moves immediately. When regulators adapt, crypto integrates into formal banking structures. When institutions allocate, crypto supply tightens in measurable ways. Volatility during geopolitical shocks isn't a flaw of the system. It's the feature of a market that never closes. Traditional finance defers stress until Monday morning. Crypto exposes it instantly. And here's the key takeaway. Despite airstrikes, oil spikes, and dramatic headlines, Bitcoin did not structurally break. It oscillated within range. That signals resilience in positioning. It suggests leverage wasn't excessively skewed heading into the event. Ethereum continues trading as a higher beta expression of macro flows, but with a long-term contraction narrative building underneath via staking. XRP, Solana, and Cardano remain tied to the broader liquidity tide, but the infrastructure stories developing beneath them matter more than short-term candles. Is crypto becoming a geopolitical escape valve? In certain jurisdictions, it already is. For institutions, it's a hedgeable macro instrument. For banks, it's emerging infrastructure. For regulators, it's an evolving compliance puzzle. That complexity is not diminishing. It's accelerating. And that's why consistency matters. Because in a 24/7 market, narratives shift quickly, liquidity rotates quickly, regulation evolves quickly. The edge isn't just knowing prices, it's understanding structure. Structure of supply, structure of liquidity, structure of regulation, structure of geopolitics. So if you're listening and you're not following the show yet, fix that now. We're back to the twice daily cadence, morning roundup. Deeper analysis later. No excuses. Markets don't pause because you're tired. Liquidity doesn't slow because headlines get heavy. Opportunity doesn't wait because geopolitics gets uncomfortable. That's when it often multiplies. Bitcoin above $68,000 signals resilience, not euphoria. Iranian outflows signal speed, not necessarily systemic collapse. European stablecoin development signals integration, not suppression. Institutional Ethereum accumulation signals conviction, not speculation. The system is evolving in real time. Drop your thoughts in the comments, hit follow, and as always, we will see you at the top.